Welcome to this explainer. Okay, today we are diving right into the absolute heart of corporate reporting for private enterprises. We're talking Canadian Accounting Standard ASPE Section 3051. If you've ever found yourself wondering how these complex corporate alliances actually translate onto paper, well, you're absolutely in the right place. Let's get into how companies account for investments where they have what we call significant influence.
Let's kick things off with a bit of a magic number in the accounting world, and that's 20%. This is basically your baseline voting interest. Hitting that 20% mark usually presumes you've got a significant say in another company's operations. So, if you hold 20% or more, the standard generally assumes you're not just some passive investor hanging out in the background anymore. No, you have a real seat at the table. But, as we'll see, accounting is rarely just black and white.
So, to make this rather dense standard super digestible, we're going to follow the complete life cycle of an investment through 4 clear stages. First, defining significant influence. Second, choosing between the cost and equity methods. Third, handling investment impairments. And finally, presentation and disclosure rules.
All right, let's start at the very beginning of this life cycle with Section 1, defining significant influence.
So what exactly does this mean? Well, significant influence is fundamentally all about the power to shape strategy. Now, this is completely different from absolute control, like when you own a subsidiary outright and call all the shots, or joint control where you're splitting the power 50-50. Significant influence simply means you have the leverage to impact their operating, investing, and financing policies. You don't necessarily hold the absolute ultimate veto power, but your voice absolutely carries weight.
Now, what if you own less than 20%? Well, don't worry, you aren't automatically disqualified. You can actually demonstrate significant influence through qualitative leverage. For example, are you sitting on their board of directors? Are you heavily involved in their policy-making processes? What about material intercompany transactions? Or maybe you're swapping key managerial personnel or providing crucial technical information. Checking these kinds of boxes means you might just have that seat at the table, completely regardless of your actual share percentage.
Okay, so once you establish that you definitively have significant influence, Section 3051 forces you to a fork in the road. That brings us to Section 2, cost versus equity method.
Under ASPE rules, an enterprise has to make an active accounting policy choice for all of its significant influence investments. You literally cannot just mix and match willy-nilly to massage your books. The standard strictly requires consistency. So you must account for all your investments subject to significant influence using the exact same chosen method. No exceptions.
Let's break down these 2 paths. The cost method is essentially the passive route. You initially record the investment at its cost, and you only recognize earnings when dividends are actually received or receivable. Easy enough, right? The equity method, on the other hand, is highly dynamic. You still initially record at cost, but then you adjust that carrying value to include your pro rata share of the investee's post-acquisition earnings. So if they make money, your investment value goes up. If they lose money, it goes down. And here is a really interesting quirk. When they pay you a dividend under the equity method, it actually reduces your investment value. Why? Because you are essentially just withdrawing a portion of the wealth you've already recognized on your books. Strategically speaking, the equity method mirrors the investee's performance directly on your own balance sheet, while the cost method smooths things out and really limits that volatility.
Let's zoom in on applying the cost method on day 1. You record the investment at the fair value of whatever consideration you transferred, but here is where people so often trip up. What about all those legal and consulting fees? Well, under ASPE 3051, you must immediately expense those acquisition-related costs in the exact period they are incurred. The only exception to this rule is a specific cost to issue debt or equity securities, because those follow their own entirely separate set of rules.
But wait, there's a massive trap to watch out for here. If the investee's equity securities trade in an active market, meaning there's a readily available public quote out there, you are strictly forbidden from using the cost method. No way around it. Under those specific circumstances, Section 3051 says you must use the equity method, or you record the investment at its quoted amount, with any changes going directly into your net income. Basically, the standard demands that if highly reliable market data exists, you absolutely must let that reality reflect in your financials.
Moving further down the investment life cycle, we unfortunately have to talk about the bumps in the road. Section 3, handling investment impairments. This brings us to a really critical question that management literally has to ask themselves at the end of every single reporting period. What exactly do we do when the expected timing or amount of future cash flows from an investment takes a significant hit? Because let's face it, accounting isn't just about recording the good times. It's about accurately reflecting reality, even when that reality kind of stings.
To help out, the standard provides an early warning system to signal if your investment's carrying amount might be overstated. You've got to watch for the red flags. Are they in significant financial difficulty? Is bankruptcy probable? Has an active market just completely disappeared? Or maybe there's been a massive adverse shift in their technological or legal environment. Think of something like a sharp decline in a commodity price that just totally ruins their business model. Hey, even a dilution of your own interest can be a red flag. If you start seeing these signs, you need to investigate.
And if you do hit those triggers, well, you have to write down the investment. Once you identify that adverse change, you reduce the carrying amount to the higher of two things: the present value of expected cash flows, or what you could realistically realize by selling it today. Crucially, that reduction is recognized immediately as an impairment loss right in your net income. You take the hit right then and there.
But it's not always a one-way street. If the situation actually improves, say the investee restructures and returns to robust profitability, Section 3051 allows you to reverse that previously recognized impairment loss straight through net income. However, there's a hard ceiling. You cannot adjust the carrying amount to be greater than what it would have been had the impairment never been recognized in the very first place. Makes sense, right?
All right. Finally, we reach the end of the investment life cycle with Section 4, Presentation and Disclosure Rules.
Now, Section 3051 requires strict separation on your balance sheet. You literally cannot just lump everything into some generic investments line item. You must visibly group subsidiaries and joint arrangements entirely separately from your significant influence investments. On top of that, you have to clearly divide them based on whether they use the cost or the equity method. And here's the real kicker. The way you group these investments on the balance sheet must be exactly how you group the investment income on the income statement. This lets readers directly evaluate the return on those specific assets, which totally prevents companies from just burying their poor investments inside some massive opaque general portfolio. And beyond the face of the balance sheet itself, your notes really have to do some heavy lifting. The primary goal here is total, absolute transparency. You have to explicitly state your accounting basis, you need to disclose fair values if an active market actually exists, and you must lay out your exact ownership proportions. And naturally, you have to shine a bright light on any impaired assets and the exact losses you've recognized. As we wrap up, I really want to leave you with this final thought to chew on. Accounting isn't just math, it's a profound language of business. The method you choose to apply from Section 3051, whether you opt for the steady, passive nature of the cost method or the highly dynamic performance-mirroring equity method, literally writes the public narrative of your enterprise's financial reality. It dictates your asset values, it drives your reported net income, and it absolutely shapes how stakeholders perceive your strategic alliances. So ask yourself, which story are your numbers currently telling? Thank you so much for joining me for this explainer on ASPE Section 3051.